Hey, Mike. How are you?
Good.
Listen, thank you for joining us on the fusion analysis panel. I thought you made some really interesting points about how you think about portfolio management and how you think about risk management. Can you just, briefly cover for us again, for the benefit of our audience, how you think about portfolio management and risk management? How do you, put the two together?
Sure. So, again, the philosophy is something you need to anchor to, something to give you an understanding of how you think about markets and how you think you're able to make money in the markets. It's an important thing to realize and help understand within yourself, because there are times when markets will act in a way that you don't expect them to act. And so for you to be able to go back to your first principles on how you think you can make money, and what you think your edge is a crucial aspect of managing money. Now, from your philosophy will come a process which should be repeatable, consistent, and help you kind of navigate the market and look for ideas and then figure out how to actually put money to work once you've found those ideas. And then finally, the risk management process. It's critical to understand that risk is going to be everywhere at the stock level and at the portfolio level. So, understanding that there is downside, that things can happen to stocks that you don't expect them to happen, and there's always a probability for loss. So, trying to figure out a way to mitigate that loss as best you can, understanding where your concentrations are, understanding that trends can fail at any point, and just trying to develop a plan to manage that and to protect the downside.
Yeah, so I think as technicians, we pride ourselves on being risk managers. So how do you think about the risk management side? Is it simple things like trend lines and stop losses, or is it more evolved than that? How do you think about it?
So it definitely starts with that. I think you know when a trend, or you hope to see that something is wrong with price action if it is evolving in that way. So you look for stop loss levels, a trend break, a certain price level break, momentum failure. Another way to think about mitigating risk within a portfolio is not being so concentrated in one sector, or at least understanding your concentrations. Not being so concentrated in one type of price structure. So, stocks are moving to different rhythms at all times. You don't want to have your entire portfolio concentrated within just stiff rising uptrends. You might maybe want to mix in some different points along the trend. So something earlier with a base breakout, combining that with a trend, I think will help mitigate the portfolio risk.
Yeah. So you do a lot of work with emerging markets, and emerging markets are pretty broad landscape. I mean, many very different countries make up the emerging markets universe. How do you differentiate between? Well, let's start with, how do you differentiate between countries, and what's your main tool for that? And how do you differentiate between sectors?
Yeah, so I think that's absolutely right. To think about emerging markets as one single index is probably not the most effective way to do it. So what I like to do is break down the entire emerging markets complex by country, and I use a lot of relative strength analysis to figure out what is leading, what's lagging, over different time frames, whether they're 10 years, 5 years, 1 year. And really anchor to those relative trends, and that allows me to concentrate my screening within a particular country, and then again I'll dig in at the country level. What are the sectors within that country that are outperforming? So again, it helps me direct concentrated screening, look for group support, look for what's actually outperforming EM and that country as well. So really optimizing the relative performance within emerging markets helps me kind of navigate that market.
Great. I think that's an interesting viewpoint on portfolio management.
All right. Thanks, Frank.
Thank you.